Welcome to Gurukul Live Lectures. The topic of today is Assessing a New Venture's Financial Strength and Viability. Now, as far as the entrepreneurial capabilities and consistencies are concerned, it is very important for an entrepreneur to see whether the project is viable and financially it has a strength or not. Because whatever dreams are there, whatever ideas are there, some ideas are not workable, certain actions are not takeable. So, it is very important for an entrepreneur to see whether the new venture which he is starting is having the financial strength and viability. So, in today's lecture, we will be talking about the 360-degree parameters which are relating to this, basically the financial strength and viability. So, I start my lecture with climate, that is the critical importance of cash. In summer 2006, Nate Elder was scuba diving off the east coast of Brazil. Now, as far as the Elder is concerned, the Elder learned the driver using the dry suits in Arctic conditions used the noble gases to insulate their wet suits when they are in the cold water. Now, back to the Utah, the Elder was a snowboard instructor and knew all about the cold. Now, this is a very important and a critical example because this is showing the critical importance of cash. Now, he wondered why the noble gases could not be used in the ski jackets to keep the skiers and the snowboarders warm. So, this was a very important question which was, under the scanning part. So, the idea stuck with the Elder, and when he returned home, he enlisted the help of the business student Nick, that is the Soden and engineer, the PhD candidate, and basically the branded wool food to see if the noble gases could be used to warm the jackets or not. Now, the basic idea was to create a jacket with a series of connected airtight chambers, which was very, very enlightening. The small cartridge filled with the pressurized argon gas would be stored in a pocket and would have the small dial on it. Now, when the dial was turned to a right, the gas would flow into the chambers and the skiers would get the jackets warmer. Now, turn the dial to the left and the gas would escape and the skiers would cool down. So, this was a very important observation which was taken care of by the Elder. Now, the secret to how the system worked is grounded in the properties of the argon gas. Now, the benefits of using the argon gas was to warm the jackets instead of the bulky fabrics is that the gas creates a thinner, lighter and more comfortable jackets. Now, Elder and his team entered into a number of business plans, which was not easy definitely, and the competitions in spring 2007 through the spring 2008. Incredibly, the team placed the first and the second in 11 business plans or the innovation competitors, winning more than about $2 lakh in the prize money and the services. The amount which they earned was stupendously high, and they were quite motivated in this regard. Now, the Climate formally launched in 2007, intending to license its technology to a major outdoor apparel companies. Now, as far as it spends about the next year, the building prototypes of the jacket aided by about $220,000 in the funds from the angel investor, because they were quite happy with the kind of innovation they were doing. And in the late 2008 and early 2009, the Elder and his team started approaching the large apparel companies hoping to ink licensing the deals. And this is when they hit their first deal and the snag. Now, while the large apparel companies, when you got to know about, routinely licensed new innovations from the technology provider companies such as 3M, DuPont, Gore-Tex, etc., and they had never seen anything like Climate's product before and weren't. So, this was the innovation which basically pushed them on the top of the business, and of course, they were able to crack their basic deals. Now, equipped to the manufacturer, in the addition, the timing was really bad, and early 2009 was the depth of the recent economic downturn. Now, the large apparel companies were in no mood to license the design from other companies regardless of how promising they seemed. Now, if the Climate wanted to bring down its novel gas insulated sky jackets to market, it would not have to do it itself. Now, the climate team decided to move forward, focusing intently on three topics: the jacket production, 1, raising the capital, 2, and a careful financial management, 3. Now, the climate had about 6 months of cash available to them, and of course, if it could not raise the additional capital in that time, it would have to close up the shops. The elder and his team also knew about they had to the penny couldn't able to do it to build the product and gain the traction and the marketplace to incent the investors to come on the board. Now, the basic design of the first product, which was named the Kinetic Vest, featuring the Noble-Tech insulation, was on the set. The challenge was to get it manufactured and into a retail outlets with the cash of the company had on hand. To produce the vest, they located the manufacturing basically in Asia, but there was a catch. The catch was that for a small company, the climate offshore manufacturers wanted 30 to 50% of the cost upfront, and the remainder they assured about the letter of credit from a particular bank. Now, the climate was able to swing this for the first shipment of its Noble-Tech visits and the West, and through the trade shows and the publicity the climate had generated, and it was able to secure the retailers for its initial batches of the product. Now, once in stores, the West started to sell and gain the traction, and of course, they armed the evidences that it could have built a product that would sell from the September to December to November 2019, and the elder and his team, they landed about $2 million in the venture capital and the angel funding. Now, it was the turning point for the climate that without the additional investment, the climate would not have had to cash and go on. The climate used the $2 million to hire a vice president of the sales and of course build the inventory, and of course it also started building the prototypes of the second product, and inflatably the sleeping pad called the Climate Inertia X-framed. They packed up the sleeping pad as about the size of 12-ounce can of a Coke and making for a hire to carry. It inflates by mouth with the air and with the argon gas, the same gas used in the Noble-Tech visits. Now, in the Inertia X-frame was ready to go in the August 2010, and it was introduced as a trade show and the rare reviews. The product is now selling in the number of retail outlets in over about 25 countries in the world, and about the major camping and sporting good chains about ready to sign in as Inertia X-frame retailers. So, all this happened because they had the idea. The idea was very noble, and it was a pioneer project, and there was no competitor at that time, and which put them on a very good position, and it expanded like a mushroom, and they penetrated the entire market. And its basic the Noble-Tech jacket, they has about evolved, and it has about several versions of it calls as the kinetic jackets, shells and its kinetic vest. So, which was definitely the USP of that particular jacket. The features it had no other vest, no other project had. Now, the climate is now at a point where it's earning or funding its operations, although the additional capital may be needed. The cash flow challenges persisted. Now, while it's gained the trust of its Asian manufacturers, they still want 30 to 50% of the cost up front for the remainder upon the shipment. The retailers typically pay the climate 30 days after the receiving of the product. This means that there is a considerable gap between paying of the manufacturers of the product and getting paid by the retailers who sells the product. Ironically, if you talk about the more successful a product based firm is, the more capital it needs to pay for the upfront of the inventory, and more than strain is the placed or its cash flows. Now, the term of the product financial management, elder is comfortable where the climate is today. Many lessons have been learned, however, about the importance of the cash flow, and it needed to sharp the financial management for a growing company. Now, in this chapter, we will talk about how the new ventures manage their finances and assesses their financial strength and viability. For the purpose of completeness, we will be now talking about the existing firms and the entrepreneurial ventures to accomplish the particular needs. Now, first, we will consider the general financial management and discuss the financial objectives of a firm and steps involved in the financial management process. Financial management deals with the two activities, raising the money and the managing the company's finances in a way that achieves the highest rate of return. Now, focusing on how the company and the manages its finances is an effort to increase its financial in an effort to increase the financial strength and earn the highest rate of return. Now, we cover the process of raising the money focuses on how the company manages its finances in an effort to increase its financial strength and earn the highest rate of return. Next, we'll examine how existing firms tracks their financial progress through preparing. Now, we will be talking about certain important aspects relating to the financial management. Now, introduction to the financial management states that an entrepreneur ability to pursue an opportunity and turn the opportunity into viable entrepreneurial firm hinges largely the availability of the money. So, if you talk about the financial management, the first thing the financial managers would see is that they have the a good amount of availability of the funds, because that is the basic nucleus of any kind of a project. If you are having the financial scarcity, if you are having some kind of problems as far as the money is concerned, then of course it will not be able to sustain for a longer period. Now, regardless of the quality of the product or a service, a company cannot be viable in the long run unless it is successfully financially available. Now, as far as the money is concerned, money either comes from the external sources or it comes from, or it can be generated from the internal sources also. So, basically when you talk about the financial management, there are two sources of finance, internal and external. Now, it is important for a firm to have a solid grasp of how it is going financially, because unless and until we are not very comfortable and not very sure about the financials of any kind of a company, you will not be able to sustain for a longer period. So, any financial manager would have to see the availability of the finance which is easily available and sustainable. Only then the success will come on the way. Otherwise, it will having a lot of problems as far as the availability of the funds is concerned, sustainability of the project is concerned. Now, one of the common mistakes which the younger entrepreneurial firms does is to not making an emphasis on the financial management and putting in place appropriate forms of the financial controls. Now, when the young entrepreneurs, they enter into a field of any kind of a business, sometimes there are big lessons which they learn that they don't bother about the financial controls, which is for that matter a mandatory condition for any of the entrepreneur to carry on, because if they are not having any kind of a financial control over their projects, then it is not very easy for them to carry on with their business. So, this is the biggest mistakes on the entrepreneurial aspect and the part which has to be checked from the very beginning. It has to be nipped in the bud also. Now, the entrepreneurs and those managing the established companies must be aware of how much money they have to put in the bank, how much money is sufficient for them for the financial obligations, and basically for how long they are able to have the funds with them which is readily available to them. So, there has to be a judicious balance of what, how, where, when, and the funds are at a very judicial position, so that they are not able to face any kind of a scarcity as far as the project is concerned. Now, coming on to another parameter in this regard. Just because a firm is successful does not mean that it does not face the financial challenges. For example, many of the small firms that sell their product, or largely the companies such as the IBM, the General Electric Company, that is the GE, and the Home Depot aren't paid for 30 to 60 days for the time they are making a sale. So, of course, these things and these questions have to be rightly answered, and this is a road which has to be nicely travelled, because if these questions are ignored, the company is not going to sustain for a longer period, because the having a good financial position, a strengthful financial position, the flow of the finances and of course the overall the needs of the finance, the utilization of the finance, if they are ignored, then it is definitely going to be a big problem for the budding enterprises which are coming all the way. Now, think about the difficult scenario which it creates if you are having a financial problems, not having adequate financial controls with you. What happens? The eventualities are really bad. The consequences are not good. So, as a financial manager, you have to be very careful about each and every step you take. Now, the small firms must buy in parts, they pay its employees, pay its routine bills, ship its products and then wait for 1 to 2 months for the payment. And unless a firm manages its money carefully, it is easy to run out of the cash even if the products or the services are selling like hotcakes. Similarly, a company grows, its cash demands often increase to a service growing to a clientele. Now, it is important for a firm to accurately anticipate whether it is able to fund its growth through the earnings or it not, and of course, will need to look for an investment capital or borrowing to raise the needed cash for them. The financial management of a firm deals with the questions like what is ongoing and what questions are there. They have to be very judiciously and diligently answered. How are we going? Are we making or losing the money? Are the big questions which always capture the mind of the financial manager. Are we going in the right direction? Are the funds invested in the right way? Are we having requisite funds with us? Are we having good investment of the funds with us? Are the resources which are available, the financial resources which are available with us, are they properly deployed or not? Because it hampers the profitability aspect also. How much cash do we have in hand? Number one. Do we have the enough cash to meet our shortcoming obligations is number two. How efficiently we are able to utilize the assets is number four. How do our growth and net profit companies to those for our industry peers, how are they managing their funds, how much money they are using, and whether we will have the funds to need for the capital improvements for the years to come or for the months to come or for the days to come. And are there any ways we can partner with the other firms to share the risk and reduce the amount of cash we need? And of course, overall we are in good shape financially. The properly managed firms, they stays on top of issues suggested by these questions through the tools and the techniques that we will discuss in this chapter and the particular questions. Now, coming on to the financial objectives of a firm. The most entrepreneurial firms, whether they have in the business or several years, like they are startups, they have the four major objectives. The first is profitability, the second is liquidity, the third is efficiency, and the fourth is stability. So, these are the four prime pillars on the basis of which we judge and take care of the objectives of the financial management. That is, you are earning good amount of profits on your funds, are you having a good amount of liquidity with you, and your funds are efficiently used, and of course, there is a stability in the organization, there is no turbulence in the organization. Now, coming on to the financial objectives of a firm, understanding these objectives sets a firm on the right finance courses and helps it tracks the answers to the previously posted questions. And the profitability. The profitability is the ability to earn a profit. Many startups are not, profitable, and the table during their first come to 3 years while they are training the employees and building their brands. But a firm must become profitable to remain viable and provide a return to its owners. The liquidity is the company's ability to meet its short-term financial obligations. And even if a firm is profitable, it is definitely often a challenge to keep the money in the bank to keep its routine obligations in a very, very important and timely manner. And to do so, the firm must keep a very close watch on the accounts receivable and of course the inventories. The company's accounts receivable in the money owned by its customers, its inventories or its merchandise, raw material, the products waiting for it to be sold. And if a firm allows the level of either these assets to go very high, or it may not be able to keep the sufficient funds in cash to meet its short-term obligations. The next is your efficiency, which is one of the major objectives of the financial management. The efficiency states what? Efficiency is how the productively and is a firm utilizing its assets relative to its revenue or to its profits. The Southwest Airlines, for example, uses its assets very productively. Its turnaround time, or the time that its aeroplane sits on the ground while they are being uploaded and of course reloaded, is the lowest in the airline industry. Now, as the Southwest officials, they are quick to point out this particular fact. Our planets does not make any money sitting on the ground. We have to get them back in the air. So, this is very important aspect. The next aspect which we talk about is the stability. Now, stability is what? It is the basic strength and the vigor of the firms in its overall financial projects. For a firm to be stable, it must not only earn a profit and remain liquid, but also keep its debt in time. If a firm continues to borrow, its lenders and debt to equity ratio, which is calculated by dividing its long-term debt by its shareholders' equity. Now, getting too tough high, it may have the trouble of meeting its obligations and securing the level of financing need to fuel its growth. So, we are taking care of the financial objectives. Till now, we have discussed so many aspects which are very important for the financial managers to look into that. Like we talked about the efficiency levels, we talked about the stability parameters and so on and so forth. So, if the firm continues to borrow from its lenders and its debt to equity ratio, which is calculated by dividing its long-term debts by its shareholders' equity, it gets too high and it may not have a trouble meeting its obligations and securing the level of financing needed to fuel its overall growth. Now, an increasingly common way that the small companies improve their prospects across several of these areas is to join buying groups or the overall co-ops where the business band together to attain the volume discounts on the products and the services. Now, gaining the access to the products and the services, this way facilitates the smaller firms' efforts to compete or more on a playing level field, and of course larger, more established firms. The overall buying groups, they work together, and how they are able to help the business to cut the cost without adversely affecting their competitiveness is described in this chapter, that is partnering the success feature. Now, we are coming on to the process of the financial management. Overall, to assess whether its financial objectives are being met or not, the firm basically relies heavily on the analytics of the financial statements, the forecast and the budgets. Now, for a financial manager to take a particular decision is very difficult. Why? Because unless and until an analytical view is taken care of, the the overall examination is taken care of, the results would not be very good. So, what the financial manager has to do? The financial manager has to scrutinize all the basic financials, the financial statements, and then the forecast and the budgets and the statements, they are going to help in taking a very judicious decision making. Now, a financial statement basically is what? It is a written statement quantitatively which describes the financial health of a particular company. Similarly, we can call that it is the language of the business which clearly depicts and exhibits whether the financials of the company are okay or not. So, the financial statements have a very significant role to play as far as the financial statements are concerned. The income statement basically is the balance sheet, and the statement of the cash flows are the financial statements entrepreneurs are used more commonly or not. The forecasts are an estimate of a firm's future income and expenses based on its past performance, its current circumstances and its present views. Now, new ventures typically base their forecast on an estimate of sales and then of course the industry averages or the experiences of a similar startups regarding the cost of the goods, which are based on the percentage of the sales and of course on the other expenses also. The budgets are basically, they are itemized as a forecast of the company's income, expenses, the capital needs and are also on the important tools for the financial planning and control. The process of our overall financial management is shown basically here. It begins by tracking the company's past financial performances through their preparation of analysis of the financial statements. These statements, they are organized and they are reported the firm's financial transactions. They tell a firm how many money is making or losing, income statements, the structure of its assets and liabilities, that is the balance sheet, and whether its cash is coming from or going on over the cash flows or not. The statement, they are very meaningful and they have a very significant role to play. The statements are also, they are helping a firm discern its acts upon against the competitors and the overall industry norms. Now, most of the firm looks at the 2 or the 3 years of the past financial statements while preparing the forecast, because they are going to give a bird's eye view of what is going to happen in the future. So, the past records, they are also very significant and also play a pivotal role in deciding the future also, because the future is dependent upon the past for some reasons of how the company is behaving, how the patterns are there, how the trends is there. So, trend analysis, the pattern designing, the pattern analysis, they are very important for the past records to decide about the future strategies of the firm. Now, the next step is to prepare the forecast or 2 or 3 years in the future. Then the forecasts are used to prepare a firm's pro forma financial statements, which along with more fine-tuned budgets constitute its financial plan. The final step in the process is ongoing analysis of a firm's financial results. The financial ratios, which depict the relationships between items on a firm's financial statements, they are used to discern whether a firm is meeting its financials or not. So, basically preparation of the historic financial statements are vital, income statements, balance sheet, the statement of the cash flows. So, it is really going to make a significant difference if you are making it in a right way. The preparation of the pro forma financial statements, the pro forma income statement, the pro forma balance sheet and the pro forma statement of the cash flows are very important statements to take care of the forecasting. So, how do we prepare the forecast? We take care of the incomes, we take care of the expenses, we take care of the capital expenditure, the ongoing financial analysis of the financial results, the ratio analysis, measuring the results versus the plans, and of course, the measuring results versus the INDES norms. So, organizing buying groups to cut the cost and maintain the competitiveness. One challenge that the business confront is cutting cost is the ways that don't erode their ability from the competitiveness. Many cost cutting techniques like scaling back on the hiring, lowering the marketing expenses, reducing the inventory, a business chances of becoming a competitive firm. So, now we are coming on to organizing buying groups to cut the cost and maintain the competitiveness. Joining or organizing a buying group is one technique that can really help to conserve a product based business financial assets without the adverse side effects. A buying group or buying cooperative is a partnership that bands the small business and startup firms together to attain the volume discounts or the products and the services. So, an example is Intercountry Appliances of buying a cooperative for 85 independent appliance store in the Northeast. The cooperative aggregates the purchasing power of its members and getting the volume discounts and applicants and the other items such as the flat screens TVs. A similar buying group is ADO, a group that service the eye care professionals. The ADO buying group has relationships with the large companies of the vendors and obtains a major discount prices on the glasses, the contact and the supplies for its members. An example of much larger buying cooperative is the Independent Pharmacy Cooperative, that is IPC, which was funded in Maidson Winson in 1984. Now, it has since into the nation's largest purchasing organization for independent pharmacies with over about 3,100 primary and 3,000 affiliate pharmacy members. The IPC is one of the major reasons that independent pharmacies were able to compete against the Walgreens, the Walmart and the CVS. So, these are the similar buying co-ops in the other industries, which are very important for you to understand. The beauty of buying the groups is that they generally allow the business to obtain the exact same number for a lower price with no undesirable impact other than the membership fees and of course on the other parts of their operations. The money that's freed upon can go directly to a business bottom line and can be used to invest in customer service or other methods to increase the competitiveness. There is no national directory of industry buying the groups. The best way to find out whether they are buying groups, services and industry is to conduct an internet research, and of course you can also ask about the industry, the participants. The objectives and how it stacks up is against its industry peers, and these ratios are also used in the asset trends. Obviously, a completely new venture would start, and its importance that a new venture would be similar and familiar with the entire process. However, now typically the new ventures, they prepare the financial statements quarterly, so that as soon as the first quarter is completed, the new ventures will have the historic financial statements to help to prepare the forecast and the performance statements for the future periods. Now, it is important for a firm to evaluate how it is faring relative to the industry. Now, sometimes the overall raw financial ratios are not viewed in the context, are deceiving of course. And with the example which I am going to quote here is, a firm's past 3 years income statements may show that it is increasing its sales over the rate of 15% per year. This number may seem very impressive, but of course, until one learns that the industry in which firm competes is growing at a rate of 30% per year, showing that the firm is steadily losing the market share. So, there is a lesson here which I want to, give you here, that standalone estimates are not good. But yes, the relative estimates are good. If you are taking a standalone example of one particular, industry that it is growing at an X rate, will not be able to have a conclusive evidence whether it is going on a right way or not. Why? Because if you are comparing that particular industry with a similar industry of the other competitor, then you would understand that yes, whether it is a leader or a lagger. So, if the other industries are growing at a rate of 30% and your industry is growing at a rate of 15%, of course, this particular company which you are talking about is a big loser, and the other market is having a good market share and is penetrating the market, whereas you are becoming a market loser because you are losing the market share. So, this thing has to be in the contextual situation only, not a standalone situation, because standalone situations is not going to solve any of the purpose. But yes, the absolute versus the relative estimates are definitely better for a better control of the industry growth and performance. So, many experienced entrepreneurs, they stress upon importance of keeping on the top of the financial management of the firm. In the competitive environments of today, which we are living and growing, in which most of the firms exist, it simply exists good enough to shoot for the hip and making the financial decisions. Reinforcing this, the Bill Gates, the founder of Microsoft, said, the business side of any company starts and ends with a core analysis of its numbers. So, even the topmost companies, the overall the founders of the big companies, they are also of this view that we are still working on the base, that is the financial statements. So, you have to be very hardcore analysis of your basic numbers if you want to be a market leader. No other estimate, no other than the financials core estimates can be a substitute in taking a substantial good financial decisions. Now, happening in your business, fraternity, and factually, if you're talking about, you are making the business decisions basing on the anecdotal data or about the gut instinct, you will eventually pay a big price. And now we are coming on to the financial statements and the forecast. The historical financial statements, they reflect the past performance, and they are usually prepared on a quarterly and the annual basis. Now, publicly traded firms are required by the Security Exchange Commission, that is the SEC, to prepare the financial statements and make them available to the public. The statements are submitted to the SEC through a number required, basically. The most comprehensive filing is a 10K, which is reported similar to the annual report, except that it contains more detailed information about the company's business. 10. The 10K for a publicly traded firm is available through SEC website, that is www.sec.gov/index.htm. So now we are coming on to the pro forma financial statements. So they are the projections of your future periods based on the forecast and are typically completed for 2 or 3 financial years in the future, because you have to have a holistic view of about 2 to 3 years together, because it is going to give you a comprehensive picture thereafter. But yes, if you see a standalone picture of only one financial year, it is not going to solve the purpose. So overall 2-3 years financial statements and the past records, they are basically very important for a financial manager to analyze and to come on to a judicious, rational decision making. Now, the pro forma financial statements which we are talking about they are the strict pro forma planning tools and are not secured by the SEC. In fact, most of the companies consider their pro forma statements to be confidential and reveal them to the outsiders, such as the lenders and the investors. Only need to know about the basis. Now, to illustrate how these financial instruments are prepared, let us have a look on the new ventures fitness drinks, the fictitious sports drink company to which we are here. The new venture fitness drinks is an example which we are taking, has been in business for the last 5 years. So they are targeting the sports enthusiasts people. The company sells to a line of nutritional, basically the fitness drinks, and it opened a single location in 2009, added a second location in 2011, plans to add another location in 2012. The company's strategy is to place the small restaurants similar to smoothie restaurants near, the open door, the sports complexes, because this is the target thing, and this is what they think that it is going to give them a lot of mileage and the profits if they are located at that place. The company is profitable and is growing at a rate of 25% per year. The historical financial statements. The historical financial statements include the income statement, the balance sheet, and the statement of the cash flows. The statements are usually prepared in this order because the information flows logically one to the next. In the startups, the financial statements are typically scrutinized closely to monitor the financial progress of the firm. And of course, on the rare occasion when the company has not used the financial statements and overall it should prepare and maintain them in any way. If a firm goes to a banker or the investor to raise funds, the banker or the investor will invariably ask for the copies of the past financial statements to analyze the firm's financial history. So, if you are talking about calculating the financial strength of any company, we have to take care of the last 5 financial statement years as a protocol, and only then you will be able to judge whether the company's financial health is good or bad. And of course, if a firm does not have these statements, and it may not be precluded from the serious considerations from the investment in a particular loan. So, overall, if you talk about the income statements, the past statements, they are going to make a lot of difference. So, I hope with these words and with these explanations, the things are very clear to you that what vital aspects are important for you to analyze to understand the financial strength, ability, and overall future perspective of any of the new venture. Thank you so much.